There's a bank run happening right now as you read this. Not the dramatic kind with lines of panicked depositors outside branches, not the social media-driven chaos that destroyed Silicon Valley Bank in 48 hours, but something quieter and potentially more dangerous. Billions of dollars are leaving the banking system every week, moving silently from checking and savings accounts into money market funds that most people have never heard of. As of mid-2025, money market fund assets have reached over $7 trillion, an all-time high, while bank deposits have stagnated or declined. This isn't panic, it's rational calculation. Money market funds are paying 5% or more, while banks are offering 0.5% on savings accounts. Maybe 4% if you're lucky enough to find a high-yield account and savvy enough to move your money. So depositors, from individuals managing their savings to corporations managing billions in cash, are quietly walking away from banks toward better returns elsewhere. And this silent bank run is transforming the financial system in ways that regulators are only beginning to understand, threatening the traditional banking model, concentrating risks in money market funds that could freeze during the next crisis, and setting up conditions for a panic that could make 2008 look manageable. Understanding this silent bank run means understanding that financial crises don't always announce themselves with dramatic collapses. Sometimes they build slowly, deposit by deposit, until the day the system breaks and everyone realizes too late that the foundation had been eroding for years. The story of this silent bank run begins with the Federal Reserve's response to inflation. After keeping interest rates near zero for years during and after the pandemic, the Fed began raising rates aggressively in March 2022, eventually pushing the federal funds rate from 0% to over 5% in the fastest hiking cycle in 4 decades. This was necessary to combat inflation that had reached levels not seen since the 1980s. But rate increases have consequences that ripple through the entire financial system, and one of the most significant was creating a massive gap between what banks pay depositors and what depositors can earn elsewhere. Banks were slow to raise deposit rates even as the Fed pushed up interest rates. There are structural reasons for this. Banks make money from the spread between what they pay depositors and what they earn on loans and investments. When the Fed raises rates, banks' costs rise because they have to pay more on deposits eventually, but their loan portfolios earn the same fixed rates for years. A 30-year mortgage issued at 3% in 2020 still pays only 3% even when market rates reach 7%. So banks face compressed profit margins, and they respond by keeping deposit rates as low as possible for as long as possible, hoping depositors won't notice or won't bother to move their money. This worked for a while. Through 2022 and into early 2023, most bank deposits remained relatively stable despite Fed rate increases. The differential between what banks paid on deposits and what depositors could earn in money market funds grew wider, reaching spreads about double the peaks seen in previous rate hiking cycles. Banks were paying perhaps 4.5% on savings accounts, while money market funds offered 4% or more, a gap of 3.5 percentage points, representing the profit banks were extracting from depositors' inertia and lack of financial sophistication. For someone with $100,000 in savings, that gap meant losing $3,500 per year by keeping money in a bank instead of moving it to a money market fund. Multiply that by millions of depositors and billions of dollars, and you understand the enormous transfer of wealth from depositors to banks during this period. But eventually, depositors caught on. Financial advisors, media coverage, and simple arithmetic convinced people that leaving money in low-yielding bank accounts was costing them thousands in foregone interest. Between the second quarter of 2022 and mid-2024, bank deposits fell by over $1 trillion, while money market fund assets surged by roughly $900 billion, an almost exact correspondence showing where the money went. This represented the largest peacetime shift of funds from banks to money market funds in history, driven not by panic about bank safety, but by rational pursuit of higher yields. The mechanics of this shift reveal how the modern financial system has become interconnected in ways that create hidden vulnerabilities. When a depositor moves $100,000 from a bank account to a money market fund, several things happen simultaneously. The bank loses $100,000 in deposits, which means it has $100,000 less to lend. The money market fund receives that $100,000 and must invest it somewhere safe and liquid. During this period, much of that money went into the Federal Reserve's Overnight Reverse Repurchase Facility, known as ONRRP, where money market funds could park cash overnight at rates close to what the Fed was paying banks on reserves. At its peak, the ONRRP facility held over $2.5 trillion, money that had migrated from bank deposits through money market funds to the Federal Reserve's balance sheet. This circular flow is economically strange. Money that began as bank deposits, which banks could lend to businesses and homeowners, ended up at the Federal Reserve where it sat idle earning interest for money market fund shareholders. The shift didn't increase overall liquidity or credit availability in the economy. It just moved money from institutions that lend it out, banks, to vehicles that park it at the Fed, money market funds. The result is a credit contraction, less lending capacity in the banking system, which translates to tighter credit conditions for businesses and consumers, even though the Fed's monetary policy rate is what it is. The silent bank run accelerated dramatically in March 2023 following Silicon Valley Bank's collapse. Suddenly, depositors who'd been slowly moving money to chase yields had a new motivation: safety. SVB's failure reminded everyone that bank deposits above $250,000 aren't insured by the FDIC, and even insured deposits can be frozen for weeks during bank failures while regulators sort things out. Money market funds, particularly government money market funds that invest only in U.S. Treasury securities and government agency debt, looked safer than bank deposits to many large depositors. They offered both higher yields and paradoxically less risk since Treasury securities are backed by the full faith and credit of the U.S. government, whereas bank deposits depend on the soundness of individual banks. The shift was most pronounced among uninsured depositors, corporations, and wealthy individuals with deposits far exceeding FDIC limits. These are exactly the depositors banks most want to retain because they're large, stable sources of funding. But they're also the depositors most sensitive to yield differences and most aware of risks. When SVB failed, many corporations immediately moved excess cash from banks to money market funds, and that money never came back even after the panic subsided. By the second half of 2023, deposit outflows had stabilized somewhat as banks finally raised deposit rates in response to competition. But the damage was done. Banks had lost over $1 trillion in deposits, their profit margins were compressed by having to pay more on remaining deposits, and the depositors who stayed were increasingly the sticky retail customers who valued convenience over yield rather than the large corporate accounts that banks rely on for stable funding. Research by Federal Reserve economists shows that the substitution between bank deposits and money market funds has varied significantly over time and depends on two key factors. The first is overall liquidity in the financial system. When cash is scarce, as it was before 2008 and during most of the pre-pandemic period, depositors actively move money between banks and money market funds seeking the best returns. But when cash is abundant, as it was during the pandemic when the Fed flooded the system with money through quantitative easing, both banks and money market funds can expand simultaneously without directly competing. The substitution effect weakens because there's enough money for both sectors to grow. The second factor is the yield differential between money market funds and bank deposits. When money market funds pay significantly more than banks, as they have since 2022, substitution from banks to money market funds becomes much more pronounced. The research finds that during periods when money market fund yields substantially exceed bank deposit rates, a 1 percentage point decrease in bank deposits is associated with a 0.3 percentage point increase in money market fund assets. This means the substitution is real, not just correlation, but causation. Depositors are actively moving money in response to yield differences. Critically, this substitution is asymmetric. When money market fund yields are high relative to bank deposits, depositors readily move money from banks to money market funds. But when the yield differential narrows, money doesn't flow back to banks as quickly. Depositors who've moved to money market funds often stay there even when the yield advantage diminishes because they've learned that money market funds offer comparable or better liquidity, safety, and convenience compared to bank accounts. This creates a ratchet effect where banks lose deposits during rate hiking cycles but don't fully recover them when rates fall. Over successive rate cycles, this gradually shifts the balance of power in cash management from banks to money market funds. As of 2022 money market fund assets stand at over $7 trillion, compared to about $15 trillion in bank deposits excluding large time deposits. This means money market funds now hold nearly half as much money as the entire banking system's deposit base, a ratio that has never been this high. And the growth continues. Government money market funds, which invest in Treasury securities and repos backed by government securities, have been the primary driver of growth, now accounting for over 80% of total money market fund assets. These funds are considered less risky than prime money market funds, which can invest in commercial paper and other corporate debt, so they've attracted the bulk of risk-averse depositors fleeing banks. But here's where the silent bank run becomes dangerous. Money market funds are shadow banks. They perform bank-like functions, taking what are effectively deposits and investing them in short-term securities, but they operate outside the banking regulatory framework. They're not subject to the same capital requirements, reserve requirements, or supervision that applies to banks. They don't have access to the Federal Reserve's discount window or emergency lending facilities in the same way banks do. And despite reforms after the 2008 financial crisis, when several money market funds broke the buck and required government bailouts, money market funds remain vulnerable to runs. The vulnerability comes from their structure. Money market funds promise stable net asset value, usually $1 per share, and investors treat them like bank deposits, expecting to withdraw money at any time at full value. But money market funds invest in securities that can lose value, and if those losses exceed the fund's buffer, the fund breaks the buck, meaning shares become worth less than $1. When that happens, or even when investors fear it might happen, they rush to withdraw money before losses materialize. This is exactly what happened in September 2008 when the Reserve Primary Fund broke the buck after Lehman Brothers collapsed, triggering runs on money market funds industry-wide that required massive government intervention to stop. The reforms implemented after 2008 were supposed to make money market funds more resilient. Prime funds, which invest in riskier corporate debt, were required to float their net asset values rather than maintaining stable $1 shares, and they were given tools like redemption fees and gates to slow withdrawals during stress. But government money market funds, which invest only in Treasury and agency securities, retain stable net asset values precisely because they're considered safer. This created the perverse incentive where investors, particularly institutional investors managing corporate cash, piled into government money market funds as the safest option, concentrating enormous sums in vehicles that could theoretically face runs if confidence broke. Now consider what happens if there's a shock to the Treasury market. Government money market funds hold over $5.5 trillion, mostly in Treasury bills and repurchase agreements backed by Treasuries. If something causes Treasury prices to fall sharply, perhaps a debt ceiling crisis, a flight from US dollar assets, or a sudden spike in inflation expectations, government money market fund asset values would decline. The funds have small buffers to absorb losses, but if losses exceeded those buffers, funds would have to either impose gates preventing withdrawals or allow net asset values to fall below $1, breaking the buck. Either outcome would trigger panic among investors who treat money market funds as perfectly safe and liquid. The interconnectedness makes this scenario particularly dangerous. When money market funds face redemptions, they have to sell assets to raise cash. If many funds are selling simultaneously, Treasury bill prices fall further, creating losses for all money market funds and triggering more redemptions. This is the classic dynamic of a fire sale spiral, where forced selling depresses prices, which triggers more forced selling. And because government money market funds now hold such a large portion of the short-term Treasury market, their collective selling could overwhelm even this supposedly deep and liquid market. The Federal Reserve is aware of this risk, which is why the Financial Stability Report in late 2025 specifically mentioned money market funds as an area of concern. But awareness doesn't mean solution. The Fed can provide emergency lending to banks through the discount window, and it created facilities after SVB's collapse to help banks borrow against securities at par value rather than market value. But money market funds aren't banks. They don't have the same access to Fed liquidity facilities. If money market funds face runs, the Fed would need to create new emergency programs as it did in 2008 and again in 2020 during the pandemic panic to provide backstop liquidity and prevent system-wide collapse. This means that the silent bank run happening now is transferring systemic risk from a heavily regulated sector, banks with capital requirements, supervision, and access to Fed lending, to a lightly regulated sector, money market funds with fewer safeguards and less direct Fed support. The $1 trillion that's moved from banks to money market funds represents $1 trillion that's now more vulnerable to runs and less directly under regulatory control. If the next crisis hits, money market funds could amplify rather than absorb the shock, potentially requiring government bailouts even larger than what banks needed in 2008. For banks, the silent bank run creates multiple problems beyond just losing deposits. First, it forces them to compete for deposits by raising interest rates, compressing profit margins in an environment where their loan portfolios still reflect the low rates of previous years. Many banks are seeing net interest margins, the difference between what they earn on assets and pay on liabilities, decline to levels that threaten profitability. Some regional banks have already reported losses or drastically reduced earnings because of this compression. Second, losing deposits forces banks to rely on wholesale funding sources like borrowing from the Federal Home Loan Bank system or issuing bonds. These sources are generally more expensive than deposits and less stable, creating funding risks. If wholesale funding markets freeze during a crisis, as they did in 2008, banks without stable deposit bases face immediate liquidity problems. The decline in deposits has thus made the banking system more fragile, even though individual banks may appear well capitalized. Third, reduced deposits mean reduced lending capacity. Banks operate on fractional reserve principles, holding only a portion of deposits in reserves and lending out the rest. When deposits decline, lending capacity declines proportionally. This means less credit available for businesses, homeowners, and consumers, which slows economic growth. The Federal Reserve has been trying to stimulate the economy by holding rates at levels it considers appropriate, but the migration of deposits to money market funds is working against that policy by reducing banks' ability to lend. The Office of the Comptroller of the Currency projects that bank deposit growth will remain sluggish through 2025, likely in the 4% to 4.5% range, significantly below historical averages. This reflects the ongoing shift toward money market funds as depositors seek higher yields and as corporations maintain more cash in liquid instruments rather than bank deposits. Even as the Fed begins cutting rates, which it's expected to do in 2025, deposits may not flow back to banks quickly because depositors have discovered that money market funds offer comparable liquidity with better yields. The silent bank run also reveals a fundamental problem with modern monetary policy. When the Fed raises rates to fight inflation, it does so by increasing the federal funds rate, which is the rate banks pay to borrow from each other overnight. This increase is supposed to transmit through the economy as banks raise their lending and deposit rates, making borrowing more expensive and saving more attractive, thus cooling demand and reducing inflation. But the transmission mechanism is breaking down because banks are slow to pass higher rates to depositors, keeping deposit rates low to protect profit margins. This creates the arbitrage opportunity that drives money to money market funds, which do pass through Fed rate increases because they compete on yield. The result is that savers, particularly unsophisticated savers who don't know about money market funds or don't bother moving their money, subsidize banks during rate hiking cycles. They earn little interest on savings while banks use their deposits to earn much higher rates through lending or investing in securities. Meanwhile, sophisticated savers and corporations move money to money market funds where they earn market rates. This creates a wealth transfer from less sophisticated to more sophisticated depositors, and from small savers to large institutions, exacerbating wealth inequality through the structure of the financial system itself. From depositors' perspectives, the shift to money market funds makes perfect sense. Take someone with $50,000 in an emergency fund sitting in a bank savings account earning 0.5% annual interest. That's $250 per year. Move that same $50,000 to a money market fund earning 5%, and it generates $2,500 per year, 10 times as much. Over 5 years, that's $1,250 in additional income for doing essentially nothing except clicking a few buttons to open a money market fund account. Multiply this by millions of households, and you see why the shift is happening despite inertia and preference for the familiar. But not everyone can or will make this shift. Many people don't know that money market funds exist or don't understand how they work. Some are intimidated by investment accounts and prefer the simplicity of a bank account they can access with a debit card. Others have too little savings for the differential to matter. If you have $1,000, the difference between 0.5% and 5% is $45 per year, meaningful but not life-changing. And some people, particularly older individuals accustomed to banking relationships, simply trust their bank and don't see a reason to move money elsewhere. This creates a two-tiered system where financially sophisticated people earn market rates through money market funds, while unsophisticated savers subsidize banks by accepting below-market rates on deposits. Banks have responded by offering high-yield savings accounts and promotional rates to attract deposits, but these are often available only online, require minimum balances, and come with restrictions that make them less attractive than advertised. The most profitable customers for banks are now the ones who don't pay attention to interest rates, who keep money in low-yielding accounts because it's convenient or familiar. Corporations and institutional cash managers face different calculations. For a corporation with $100 million in cash reserves, the difference between a bank account at 0.5% and a money market fund at 5% is $4.5 million per year, an amount that CFOs can't ignore. Fiduciary duty requires corporate treasurers to manage cash prudently, maximizing returns within safety constraints. Money market funds, particularly government funds investing in treasuries, meet those constraints while offering substantially higher yields than bank deposits. So corporate cash has flooded into money market funds, and it's not coming back even if banks raise deposit rates somewhat, because corporations have realized they don't need traditional bank deposits for most purposes. The implications for banking are profound and potentially existential. If deposits continue migrating to money market funds, banks lose their core competitive advantage: low-cost funding from deposits. Without deposits, banks become more like other financial institutions, dependent on wholesale funding markets and capital markets to finance their operations. They would have to pay market rates for funding, which means they could only profitably make loans at rates high enough to cover market funding costs plus a profit margin. This would make credit more expensive and less available, particularly for riskier borrowers who already pay premium rates. Some argue this would be a positive development, that banking should operate on market principles rather than exploiting depositor inertia. If banks had to pay market rates for funding, they'd be forced to be more efficient and selective in lending, potentially reducing the kind of reckless credit expansion that leads to bubbles and crashes. But it would also mean that banking as we know it, the model where deposits fund loans with banks earning a spread, would essentially end. Banking would transform into something closer to the originate-to-distribute model, where banks make loans but immediately sell them to investors rather than holding them on balance sheets funded by deposits. We're already seeing this transformation in mortgage lending, where most mortgages are packaged into securities and sold to investors rather than held by banks. But extending this model to all lending would mean banks become primarily service providers and intermediaries rather than balance sheet lenders. The economic implications are uncertain. It might mean more efficient allocation of capital, or it might mean less credit availability and greater financial instability, as lending becomes more dependent on fickle capital markets rather than stable deposit funding. For money market funds, continued growth brings both opportunity and risk. Assets under management generate fees, so money market fund sponsors, companies like Fidelity, Vanguard, and BlackRock, benefit from the shift of money from banks. But managing trillions in assets that investors treat as perfectly liquid and safe is an enormous responsibility. One operational failure, one investment loss that breaks the buck, one day when redemptions can't be met immediately and the entire industry could face runs that destroy confidence. The regulatory response has been halting and inadequate. After 2008, reforms made prime money market funds slightly more resilient, but didn't address the fundamental fragility of the money market fund model. Government money market funds, where most of the growth is happening, face even less regulation because they're considered inherently safer. But concentration of $5.5 trillion in vehicles dependent on Treasury market stability and investor confidence is itself a systemic risk that regulators are only beginning to acknowledge. Some experts have proposed requiring money market funds to hold higher capital buffers, essentially forcing them to operate more like banks with loss-absorbing capital. Others suggest eliminating stable net asset value entirely, making all money market funds float their share prices so investors can't treat them as deposit substitutes. But these reforms face resistance from the industry and from investors who like money market funds precisely because they function like bank accounts with better yields. Any reform that made money market funds less deposit-like would reduce their appeal and might push money back to banks, which could be the intended effect but would also mean investors accepting lower returns. The deeper question is whether the current financial architecture is sustainable. We have a banking system that depends on deposit funding but struggles to compete for deposits when rates rise. We have money market funds that attract deposits during rate hiking cycles but could face devastating runs during market stress. And we have a Federal Reserve that tries to manage monetary policy through interest rates but finds that policy transmission is distorted by deposit migration between sectors with different regulatory frameworks and different levels of Fed support. The silent bank run that's happening now, the steady flow of over $1 trillion from banks to money market funds since 2022, might be manageable if it stabilizes and doesn't accelerate further. But it's set up conditions that make the next financial crisis more likely and potentially more severe. When crisis comes, and it will come, money market funds could face runs requiring government intervention. Banks with weakened deposit bases could face funding crunches. And the interconnections between banks, money market funds, and the repo markets that link them could transmit stress rapidly throughout the system. Understanding the silent bank run already happening means recognizing that financial instability doesn't always announce itself with dramatic collapses. Sometimes it builds slowly through rational individual decisions that collectively create systemic fragility. Every depositor moving money to a money market fund is acting rationally, seeking better returns and potentially greater safety. But millions of depositors making that same rational choice are undermining the deposit base of the banking system, concentrating risk in money market funds and setting up dynamics that could trigger the next crisis. The irony is that this bank run is caused by central bank policy. The Federal Reserve raised rates to fight inflation, which created the yield differential that drives deposits to money market funds. The Fed knows this is happening. Their own research documents it in detail. But they can't prevent it without either forcing banks to raise deposit rates, which would hurt bank profitability, or lowering rates prematurely, which would risk allowing inflation to resurge. So the silent bank run continues, reshaping the financial system deposit by deposit, billion by billion, while regulators watch and hope it doesn't accelerate into something more dangerous. If this gave you a new perspective, hit subscribe. History doesn't repeat, but bank runs never stop. They just evolve, taking forms that regulations don't anticipate and that people don't recognize until it's too late. The silent bank run happening right now is moving your neighbor's money, your company's money, maybe your own money from banks to money market funds. And when everyone realizes simultaneously that money market funds aren't as safe as they assumed, that Treasury markets can freeze, that $7 trillion in supposedly liquid assets might not be accessible when everyone needs cash at once, the silent run will become a screaming panic. And by then, the only question will be whether government bailouts can stop it before the entire shadow banking system collapses, taking the real economy down with it. The run is happening now, silently, rationally, inevitably. And almost nobody's paying attention.